The Cash Flow Compounder, a comprehensive guide to the Vanguard High Dividend Yield ETF, VYM. As of March 11, 2026, the global investment landscape is grappling with a stagflationary scare. With the U.S. labor market showing a surprise loss of 92,000 jobs in February and crude oil surging toward $100 per barrel due to Middle East supply fears, the growth at any price mentality of previous years has hit a wall. In this environment, the Vanguard High Dividend Yield ETF, ticker VYM, has transformed from a boring value play into a strategic essential. Earlier this month, on March 10, 2026, VYM closed near $150.71, holding on to significant gains from its 52-week run. For an investor today, VYM is the ultimate defensive income vehicle designed to provide high current yield and stability while the broader S&P 500 navigates geopolitical shocks and inflationary headwinds. This researcher's deep dive will break down VYM's ultra-low fee structure, its massive $75 billion portfolio, and the strategic reasons why this fund is the gold standard for cash flow seekers in 2026. What is VYM, the High Yield Blueprint? VYM tracks the FTSE High Dividend Yield Index, which measures the investment return of common stocks of U.S. companies that are characterized by high dividend yields. Unlike dividend appreciation funds that look for companies growing their payouts, like VIG, VYM targets companies that are paying out now. The 2026 fee cut. In a significant move for income investors, Vanguard recently cut VYM's expense ratio to 0.04%, down from 0.06%. This makes it one of the cheapest high-yield ETFs in existence. For every $10,000 you invest, you pay only $4 per year in management fees, ensuring that almost 100% of the dividends stay in your pocket. The High Yield Filter. The fund uses a forward-looking screen. It selects companies with above-average forecasted dividend yields and ranks them. It excludes real estate investment trusts, or REITs, which are often subject to different tax treatments, making VYM a cleaner play for traditional corporate dividends. The 2026 portfolio, the blue chip backbone. As of March 2026, VYM holds approximately 562 stocks. The portfolio is the who's who of American industrial and financial might. Unlike the tech-heavy S&P 500, VYM is weighted toward sectors that generate real-world cash flow. 1. Financials, approximately 21% of the fund. Led by JP Morgan Chase, this sector is a major driver of VYM's income. In early 2026, banks are benefiting from a higher-for-longer interest rate environment, which has bolstered their net interest margins even as loan growth slows. 2. Technology, approximately 15% of the fund. Wait, technology in a dividend fund, you ask? Yes, in the quality rotation of 2025-2026, mature tech giants like Broadcom, AVGO have become top holdings. Broadcom, currently VYM's largest holding at approximately 6.9%, is the bridge between AI growth and dividend stability, providing the chips for the AI data center boom while paying a significant yield. 3. Energy and industrials, approximately 23% combined. Top holdings like ExxonMobil, XMO, and Chevron, CVX, have been the geopolitical hedge for VYM in 2026. As oil prices spiked this month, these energy giants provided the capital appreciation that offset losses in other parts of the market. Performance and dividend vitals, March 2026. VYM is not a get-rich-quick stock. It is a compound interest engine. The financial scorecard, as of March 11, 2026. Current market price, $150.71. 52-week range $109.92 to $157.29. Dividend yield SEC 30-day 2.29% to 2.44%. Q1 2026 dividend. The next ex-dividend date is scheduled for March 20th, 2026. 3-year return, approximately 58.1%. 10-year return, approximately 223.1%. The compounding effect. For an investor who started in 2016, the yield on cost would now be significantly higher than the current 2.4%. Because VYM focuses on companies that can sustain their dividends, the actual dollar amount of the quarterly check tends to grow over time, even if the yield percentage stays stable relative to the rising stock price. Macro 2026. Why have dividend stocks been in vogue now? Why has VYM seen over $2 billion in net inflows in the last month? 1. The stagflation hedge. Inflation is proving sticky in 2026. When prices rise, companies with pricing power like Johnson & Johnson or Procter & Gamble, both VYM top holdings, can pass those costs to consumers, maintaining the profits needed to pay dividends. 2. The yield gap. While 10-year treasuries are yielding around 4.2%, they offer no growth. VYM offers a 2.4% starting yield, plus the potential for capital appreciation and dividend increases. In a volatile market, investors are choosing the total return potential of equities dividends over the fixed nature of bonds. 3. The oil spike protection. With Middle East tensions pushing crude toward triple digits, VYM's 9% allocation to energy provides a natural buffer. While the S&P 500 suffers from higher energy costs, VYM's energy holdings act as a profit engine. Critical risks, the dividend trap, and interest rates. As your investment researcher, I must warn you that high yield is not no risk. The interest rate anchor. Dividend stocks are often viewed as bond proxies. If the Federal Reserve is forced to raise rates again in mid-2026 to fight oil-driven inflation, VYM could face selling pressure as investors move back into high-yielding cash accounts. Growth lag. In a true bull market, like the AI frenzy of early 2024, VYM will almost certainly underperform the NASDAQ or the S&P 500. You are trading explosive upside for defensive stability. Sector sensitivity. With 21% in financials, VYM is sensitive to the health of the banking system. If the stagflation concerns lead to a credit crunch or a spike in loan defaults later in 2026, the financial segment could see a sharp correction. Strategy. How to position VYM today. In March 2026, the smart money is using VYM as a volatility buffer. The core role. For many retirees or conservative investors, VYM is the 30 to 50% of their core equity portfolio. It provides the ballast that keeps the portfolio steady when tech stocks are dropping 2% a day. The drip factor. The best way to play VYM is through a dividend reinvestment plan, or DRIP. By automatically using your quarterly checks to buy more shares, you capitalize on the compounding miracle. At $150 a share, every dividend check buys you a fraction of a new share that will in turn pay its own dividend next quarter. The support level entry. Technically, VYM has strong support at the $145 level. If the current macro turbulence pushes the fund down 3 to 4% from here, it would represent a value entry with an even higher effective yield. Conclusion: the fortress of income. The Vanguard High Dividend Yield ETF in 2026 is a story of steady wins the race. While the world is distracted by the next AI breakthrough or the latest geopolitical crisis, the 562 companies inside VYM are quietly shipping products, providing services, and cutting checks to their shareholders. The verdict: If you are a long-term investor who values cash flow over hype and wants to build a portfolio that can withstand the stagflationary headwinds of 2026, VYM is the gold standard. With a record low 0.04% fee and a $75 billion asset base, it's the most efficient way to turn the global economy into your personal income stream.